Good morning, everyone. Welcome to the Foreign Correspondents Club of Japan. I'm Anthony Rowley, a former president of the club, and I will be acting as moderator today. Today's event is the latest in what we call our deep dive series, in which we ask panels of experts to discuss topics of current interest. Okay, and today's event we have called Central Banks, excuse me, what next after the BOJ move? And we've got a panel of 4 experts here this morning to offer their views on this subject. Let me introduce them right away. Joining us from New York is Paul Sheard, whom I hope you can see on the screen, who is the author of The Power of Money, and he's a former research fellow at the Harvard Kennedy School. And here in the room to my right is Sayuri Shirai, who is a former Bank of Japan Policy Board member, and she's also an advisor to the Asian Development Bank Institute, the ADBI. Then again, going back to New York, at lightning speed, we have Richard Katz, who's author of the book The Contest for Japan's Economic Future, Entrepreneurs versus Corporate Giants. And last but certainly not least, on my left is Ms. Naomi Fink, who is Global Strategist at Nikko Asset Management. Okay, so the immediate peg, obviously, for today's event was the Bank of Japan's recent decision to end its negative interest rate policy, a move which has provoked intense interest and media coverage in and beyond Japan. So why are we returning to the subject today? Well, because the BOJ move last week is by no means the end of the story. What central banks do in coming months is of critical interest, I think, to financial markets, financial institutions, and to the global economy. And central banks are likely to come under strong political pressures in an election year. And also some people are suggesting that the financial system may see problems quite soon, if not an actual crisis. But anyway, let me not say any more. Let me hand over to Paul Sheard, who will speak first. And if I could just remind you, if you have a mobile phone, to switch it off or put it on manner mode as a courtesy to our guests. So, Paul, if you would, please.
Well, thank you very much, Anthony. It's a pleasure and an honor to be here. Always a great platform at the Foreign Correspondents Club of Japan, even if we're doing it from New York. So, Anthony, I think you wanted me to start off by setting a little bit more of a global context as we sort of drill down to the Bank of Japan. So in my opening remarks, I'd just like to do 3 things. One is to put the current global situation in a sort of recent historical perspective, because I think it's been a roller coaster of a few years. And I think that may be helpful in sort of getting a bit of a beat on where we're headed next. Then I'll talk a little bit about sort of how the outlook and some of the risks out there. And then I'll touch on the Bank of Japan in my sort of third point, and then segue to the other speakers. So, it is the last few years, it's been quite remarkable, obviously, and I won't spend too much time here, but the starting point now is, of course, that the Fed and the other major central banks, not the Bank of Japan really, but the other central banks, have just spent the last few months hiking interest rates, last few months on hold, pretty much, after having spent a year or a year and a half rapidly raising their interest rates. The Fed, for example, raised its interest rate from close to 0 up to 5.25% to 5.5%, and it's been sitting there for the last 7 or 8 months. 525 basis points of interest rate tightening in about a year, from March, maybe 15 months, from March 2022 to around about July 2023. Most of the other central banks, did more or less a similar thing. The ECB took the interest rate up to their main deposit rate to 4%. The Bank of England took its rate up to 5.25%, et cetera, et cetera. You can go through the major central banks. They all went from a very low interest rate, negative in some cases, up to 4 or 5% kind of territory. And of course, the reason for doing that was because they had to respond to this global inflation shock. And that global inflation shock, of course, was a result of the COVID the loss of demand, which was then followed by dramatic stimulus and a pretty strong recovery, where the demand, which was surging in the economy, ran into some very serious supply constraints. If you go back to pre-COVID, the thing that people were worried about then, central bankers were worried about, was so-called secular stagnation, low natural rate of interest, or R star. And some of the central banks, like the ECB, for example, were still operating in negative interest rate territory. But even the Federal Reserve, prior to COVID, had only managed to get its policy rate up to about 2.5%. So we've gone through this real roller coaster period, where now the focus of the markets looking forward is, when are the major central banks, particularly the Fed, going to start cutting interest rates? And if you look at the Fed is kind of signaling, when you kind of divine or go through its quarterly summary of economic projections, back half of this year, maybe 75 basis points of rate cuts, 2025, another 75 basis points, 2026, long way away, obviously, but another 75 basis points. That's kind of the interest rate trajectory that the Fed itself is signaling. Now, the Bank of Japan in all of this is kind of the odd one out, because they did not. Well, they did experience the loss of demand back in 2020 and then the surge of inflation in 21, 22. It wasn't of the scale that we saw in the US and Europe. And of course, the Bank of Japan's starting point, for all the reasons we're very familiar with, was very different. And so they haven't been able to raise interest rates in the way that other central banks. So the question for the Bank of Japan is a very different question from the other central banks. Again, they're out of sync. We're looking at the other central banks and saying, when will the Fed cut? When will the ECB cut? When will the Bank of England cut? Swiss central bank has already started to cut, but we're looking at Bank of Japan and wondering, are they going to start raising interest rates? So it's a fascinating situation. So I'm kind of moving into the second point, which is kind of the outlook and some of the major risks from here. Again, maybe focusing more on the US, where I'm sitting at the moment. The US has come through this roller coaster period, in pretty good shape. It's the Fed, while getting the inflation picture gloriously wrong in 2021 and 2022, making some serious forecasting errors, has managed to raise interest rates from close to 0 to 5.25% to 5.5%. Without tipping the economy into recession. The labor market is still very, very strong. So they've sort of pulled off this, so far at least, this kind of soft landing scenario. Meanwhile, inflation has come down. Most people focus on the CPI. That's still somewhat elevated, around about 3.4%, and it's been pretty sticky in year-on-year terms for the last 6 months or so. But the measure that the Fed actually targets and focuses on, the personal consumption expenditure, so-called PCE, is down to about 2.4%, is likely to keep coming down slowly. So the Fed does seem well positioned, perhaps to start to cut interest rates, in the second half of the year. You might say, well, why should they be cutting interest rates if unemployment is pretty good, labor market's strong, inflation is coming down towards target? Why don't they just leave their interest rate where it is? And of course, that has all to do with the sort of leads and lags in monetary policy. The fact that there is such a cumulative sort of monetary tightening that has been put into the system, that the Fed and other central banks would be concerned that that monetary tightening, that restraint will start to catch up with the economy with a lag and push it into recession. So central banking is always forward-looking, and central banks have to anticipate what lies 6 to 9 months ahead rather than react just to the current situation. Yield curves in the US and around the world are inverted, most of them in the major central banks. That means that the policy rate is above the long-term interest rate, the 10-year rate. Often people say, well, that means that markets are forecasting a recession. That's not really true. What markets are forecasting is that interest rates will have to come down, that the policy rates are at levels which are, very high relative to the so-called neutral rate, the rate that you might expect if the economy is back in balance, full employment, low stable inflation. The Fed currently puts that rate in the US at around about 2.5% to 3%-ish territory, closer to 2.5%. So 5.25% to 5.5% puts you a long way above that so-called neutral rate. Now, they might be wrong about the neutral rate. We'll have to wait and see about that. But definitely, the Fed's intent is for the next cut to be down. Now, the picture in Europe is not quite as rosy. The economies, in the euro area, the UK, growth has really stalled somewhat. So it would not be a surprise to see the ECB and the Bank of England moving a little bit ahead of the Fed because of the different inflation outlook and the different level of economic activity. Then we have, of course, if we move to emerging markets, the big kind of elephant in the global room is China. China is expected to grow, this year and next, something with a 4% handle. I think the IMF has around about 4.6% for this year, 4.1% for next year. That's well below the kind of growth rates we've expected from China or got used to in the past. But still, under the circumstances, is probably not too bad, given the real estate headwinds and some of the other sort of perhaps some loss of exuberance in the private sector in China, and also the geopolitical and geoeconomic fragmentation that we're starting to see. India is, on the other hand, among the major emerging markets, the one that is showing much more promise and seems to be consistently now growing at a faster rate than China. Let me just now turn to the Bank of Japan, and I know the other speakers will dig into this much more than I would. Let me just make three kind of broad comments how I see the Bank of Japan's recent move. Prefaced again by the point that I hinted at before, that the Bank of Japan is unique, of course, because it's been trying for a couple of decades to get out of mild chronic deflation and achieve a 2% inflation target. And so for the Bank of Japan, or for Japan more generally, this global inflation shock was in some sense, kind of welcome, gave them an opportunity to hitch their sail to the inflation wagon, and I'm mixing metaphors here, and perhaps use that inflation shock as an opportunity to get out of that chronic mild deflation. So we'll have to wait and see how that pans out. But three quick comments on the Bank of Japan. One is that this move, which people I'm referring to as the exit from zero interest rate policy. Again, of course, that happened, but it's much more than that. This is a framework shift, framework change, moving away from QQE with yield curve control back to an operating regime, which we haven't seen for a long, long time in Japan, of the Bank of Japan just using the overnight interest rate as the key operating variable for monetary policy. So, the Bank of Japan watchers, like people on this panel, every few years seem to have had a major framework shift. I mean, the move to quantitative easing back in 2001, even comprehensive monetary policy and the asset purchase program under Governor Shirakawa back in October 2010. And then, of course, we had QQE, then QQE with negative interest rates, and then with yield curve control under Governor Kuroda. So, under Governor Ueda now to see the Bank of Japan saying, okay, that's all behind us as a framework, and now we're moving back to targeting the overnight rate is a major historical shift. However, second point is, that said, not very much has changed so far, at least in terms of monetary policy settings. So I'm making a distinction here between monetary policy settings and the framework. The framework's changed. The settings haven't changed that much, 20 basis point increase in the overnight rate. Bank of Japan has turned off the ETF purchases, but if you look at the year-on-year rate at which they were running, it was pretty modest. Same with J-REITs. And of course, the Bank of Japan, or not really of course, but what many will have noted is that the Bank of Japan is continuing to purchase, for the time being at least, JGBs at a rate of about 6 trillion yen per month. Again, we'll have to wait and see how long that lasts. But changes in framework are significant because or even the beginning of a new a shift in monetary policy in terms of a change in direction, the first rate cut, the first rate hike, very significant because central banks usually, if they make one move, it's the beginning of a series of moves. That leads me to my third point. Where does the Bank of Japan go from here? And I think the Bank of Japan may buck that usual sort of rule of central banking that if you make one move, it's followed with a whole series of them. Because I think the Bank of Japan is likely to take it very cautiously and very slowly from here, given the outlook, given the economy has shown weaknesses lately. The Bank of Japan itself has recognized that, and that actually made the timing of the Bank of Japan's framework move a little bit surprising to many of us Bank of Japan watchers. Perhaps we're not expecting such a shift so early. So they're taking a little bit of a risk here. I, for one, certainly wouldn't be surprised if the Bank of Japan now sits around about zero. Maybe at some point they move the overnight rate up to 25 basis points. But I would not be surprised if we're sitting here at the end of the year, same time next year, with the Bank of Japan not in a very different position. Perhaps they'll taper the JGB purchases, but in terms of the target interest rate, I wouldn't be surprised if we're sitting at a pretty low interest rate for an extended period. But that's going to depend, as always, on the state of the economy and the state of inflation in particular. So let me stop there, Anthony. Hand it back to you and the panel.
Thank you, Paul. Absolutely on time. So we'll move to Shirai-san, who's going to focus specifically on Japan. So Shirai-san, if you would.
Yes. Thank you very much for inviting me. So this time, there's a lot of attention globally on BOJ's policy. I got 12 contacts from international media. So I will try to explain some detail about Japan's economy and inflation. So for example, if we look at the US inflation, so based on CPI, 3.2%, based on PCE inflation, 2.4%. So it looks quite good, and the inflation is coming down. But if we look at the services inflation in US, it's around 5%. Wages are growing about 4%. So therefore, some people may worry about stickiness. Now let's look at what will happen to the case of Japan. Okay. So I will first talk about Japan's inflation economic performance. So this is a usual various inflation indicator. So green is a headline, and red is BOJ's preferred core inflation, excluding fresh food and energy. And blue is equivalent to global core inflation definition, which is excluding all food and energy. But anyway, gradually you started to see a decline in inflation. If we look at, if we divide those Japanese inflation, which is currently about 2.8%, into goods and services, this classification is important because if we want to achieve 2% in stable manner, after all, we have to look at services. goods are quite volatile, and the goods include a lot of quality. So quality improvement is recorded as a decline in prices. So if we want to achieve 2% in any central bank, they usually pay attention to these services. Now, if you look at the services, at this moment, to a great extent, inflation comes from goods. Now, let's look at the goods inflation. So we just now pay attention to the goods inflation and contribution based on food and utility and residual. Now, let's look at the right-hand side. That is our latest data. So at this moment, you can see food is a very important component. And the utility, very low contribution because the government continues to put subsidy on the utility prices. So gradually, you start to see this downward pressure is coming, will gradually weaken. So eventually, contribution from food inflation will come down. And in the meanwhile, contribution from energy will start to pick up. Okay, so there is a up and down impact there. So right now, food inflation is 4.8%, contributing 50% of total inflation. Okay, so it's a basically commodity-based inflation. Energy at this moment minus 1.7%, but this negative magnitude is declining. So because of these small negative numbers, it gives upward pressure on inflation. So assuming there is no change in food and energy, current inflation would have been 1.6%. So if we just exclude those commodity subsidy impact, actual inflation is already below 2%. Now let's look at services inflation, which is more important. Please look at the right-hand side. Right now, inflation is around 2.2%. So Governor Ueda also mentioned at the press conference, inflation, services inflation is 2%, so that is good sign. If we look at these pictures, 70% of these services come from only 3 items. One is mobile phone charges, which is growing about 10% annually, but this is not going to be sustainable. It's just once a year, the increase. Another contribution comes from hotel fee, which is growing by 30%, but this is purely inbound demand and it's nothing to do with domestic demand. And then there's all of a sudden this blue colors, overseas package travel fees, which suddenly increased by 60% and from over these 2 months. I think this is related to yen-driven, higher cost-driven inflation. So once you exclude all these 3 items, you can see very tiny inflation coming from other services. So, hotel fee is growing at 33%. Overseas package travel fees are growing 70%. The mobile phone call charges 9%. So this accounts for 70% of services inflation. To summarize my point about current inflation, so there's a substantial impact from food prices and energy subsidies. As I suggested earlier, if those changes were zero, actual inflation would have been 1.6%. Services inflation is 2.2%, but 70% come from only 3 items. If all these 5 items, well, there is no changes right now, 0%. Actual inflation is only tiny 0.9%. So it's very difficult for us to say inflation of 2% is sustainable at this stage. Now let's look at the consumption. Remember when the Bank of Japan want to have a virtuous cycle between wage and prices, I think they assume that demand will be growing, right? Demand-driven economic growth. But if you look at over this 30 years, the real consumption in Japan is stagnant. So average real consumption growth is only 0.6%. And especially over these past 10 years after COVID-19 pandemics is so stagnant and even hasn't recovered the pre-2019 level. So you can see consumption is extremely weak. Now let's look at in more detail about this household consumption by dividing into real consumption and prices. So you can clearly see the prices started to pick up from 2022. So you can see orange line is growing. And interestingly, the real consumption is dropping over time. So you can clearly see because of the higher prices, the household try to save because of the tighter budget. So at this moment, we don't really see this growth in real consumption. Let's look at in more detail by commodities. Okay, so real consumption. Let's look at food. Remember, food accounts for 50% of total inflation. So right now it's growing around 5%. So blue one, please look at blue. So because of the higher food prices, food real consumption is dropping since COVID-19, never recovered. So I think this means consumer really feel food are going really high, and that's why when there is a opinion survey, the first thing everybody want the government to take care of is price hike. So because of this high price stability, price hike, people are saving more. If we look at the other commodity such as entertainment, household supply, clothes, everything is very stagnant. So they haven't even recovered the pre-COVID-19 pandemic's level. So consumers at this moment, there's no better off. Let me show you a couple of other items. So there are some items where we saw some increase in real consumption. Those are one, health, and everybody go to the hospital now. So health and medical care, you see some increase compared to the pre-COVID-19 pandemic level, the blue one. And another one is this transportation, communication, mobile phone, everybody use internet. So there are some increase in the demand for internet services. But the other things, if you look at the utility or housing spending, all are dropping. So it's very difficult to say the household are getting worse off. Now, why consumptions are so weak? Obviously, because there's no, remarkable wage growth. So this is nominal and real wage salaries growth year on year. So I show it from 2022, and then please look at right and down. So if we consider spring negotiation, the spring negotiations impact will be reflected from April wages. So let's look at April, December last year, the average salary growth year on year, which was 1.3%. Even though the spring negotiation successfully achieved 3.6%, but once you include small medium enterprises, actual wages are actually quite low. And because of the higher inflation, the real wages were actually dropping by 2.3%. What is worse? This situation is worse than previous year in 2022. Even though spring negotiation was much better last year compared to 22, but the actual wages was much better in 2022. The nominal wage growth averaged 1.9%, and real inflation was not so bad. So real wage inflation, real wages was dropping by 1.6%. So we cannot really just look at the Shunto spring negotiation because our economy is dominated by small medium enterprises. They are not in a good business condition. So we have to look at their situation. So ideally, BOJ could wait not to take action in March, but just based on the transitory preliminary Shunto result. They could wait until June when the first April data come up. So ideally, they could have waited, but I think they were really rushing to remove this long-standing negative interest rate and yield curve control. Maybe they wanted to take opportunity. But ideally, from central bank's management point, if they want to look at the virtuous cycle between wage and prices, I think they have to look at small, medium enterprises. Okay, so that is a situation. It's not very good. And then this is from BOJ survey, the household income perception and outlook. If you look at blue, this is how households feel their income compared to 1 year ago. And this is a difference between people who said increase minus the percent of respondents who said decline. So negative means a lot of people say actually incomes are dropping. And then outlook is what will happen 1 year from now. In any case, there is no significant improvement in wage outlook and the actual wage perception so far. So it's a bit difficult for households to really anticipate, this sustainable wage growth. That we haven't seen that yet. Now, when BOJ say wage price purchase cycle, what does it mean? For example, in the case of United States, their nominal wage growth, of course, unit is different, so, but this is just as a reference, okay? So in US, the nominal wage growth is 4.3%. The real wage growth depends on whether we use CPI or PCE, but the real wage growth is growing by 1 to 2%, and real consumption is still growing. This is maybe can be a sort of a example of wage price purchase cycle happening in US. In the case of Japan, nominal wage is okay. This is I just prepared, but this January data came and 2%, but we don't know. It's highly volatile. So anyway, the December wage was 0.8, and then last year the calendar year average was 1.3. Okay, and the real wage is negative, and the real consumption is dropping. So it's very difficult for me to find out this. There is a sign of wage price purchase cycle, which Bank of Japan keeps emphasizing. I think it's very difficult to see that. Maybe some large company, they are having a lot of merger and acquisition, joint businesses. So large company are increasing profitability, so they can pay high wages. So maybe those employers may be consuming more. But the global, whole Japanese economy, it's very difficult to see wage price purchase cycle. Okay, and output gap is still negative. So that means BOJ probably was in a rush to take this opportunity to get rid of it. So as Paul also mentioned, I agree with him. The important thing is, yield curve control was a combination of short-term interest rate, negative interest rate, and 10-year yield target set at 0% with some ceiling reference at 1%. And the important thing is, at least on short end, they completely normalize the monetary policy. So they now reintroduce this interbank call rate 0 to 0.1%, exactly same as what Shirakawa's regime used to do. And also interest rate on excess reserve also became same. So a complete normalization in terms of short-term interest rate. But there also 10-year yield target was removed, not only just 0%, but the 1% reference limit. But also most important, overshooting commitment. Because overshooting commitment means BOJ will continue to increase monetary base, basically balance sheet, until core inflation will be above 2% in stable manner. So if this overshooting commitment was there, probably BOJ has to commit to increasing balance sheet, but they also remove this. So in that sense, it's quite big framework change. Okay, but because BOJ worry about this volatility of 10-year yield, so then they said they will continue to buy same amount of JGB purchases for time being 6 trillion. I think that also helped to not to have an overshooting this time, and then also number 3, stock purchases discontinue. So overall, overall it was good, and then but my point is that maybe BOJ was in a hurry, and then probably condition to remove this kind of monetary easing was not really well placed. Okay, that's my point. So the challenge will be whether is it possible for Japan to achieve 2% in stable manner based on this domestic demand wage growth. So that is, as I said, there is a lot of uncertainty. Okay, there might be Japan may have some positive inflation, but that may be coming from more cost push. I think we have to distinguish wage growth coming from cost push and demand driven. Right now, Japan, we have a clearly labor shortage. The physically working numbers are not declining. Then that leads to the higher wages. That's a cost push, So such kind of cost push may increase some retail prices and also this geographical political risk. So people produce in Japan or US, but at more expensive prices. So those leads to higher prices, but it's not that demand driven. So it's not really clear whether 2% is sustainable in the future. Finally, so many people will expect BOJ will take second move, but from domestic weakness, it's very difficult for BOJ to raise interest rate. But because the unfortunately huge yen's depreciation, so there might be some pressure for BOJ to take some position, but then there will be dilemma because domestic demand is really weak. And also this uncertainty about the yen dollar rate, this is a big concern, but it's very difficult for BOJ to take care of this. Okay, thank you.
Thank you very much, Shirai-san. Some interesting perspectives. Richard, let's turn to you now for your perspective, please. Sorry, microphone doesn't seem to be working.
Can you see the slides?
Yes.
Okay, very good. Anthony, I think it was entirely unfair of you to have me speak after Shirai Sensei because she said all of the things that I wanted to say. Or I should say, I actually have some more things to say, but I agree with, almost everything she said. Only reason I say almost is maybe there's something I disagree with, but basically I completely agree with her points. But let me start off saying this. First of all, what since we're talking about what the future is for interest rates, there are two things. One is Bank of Japan policy, but the second thing is what is the real supply and demand situation for credit in the economy? And in other words, there are people who say, well, if Japan simply did what other central banks do and just really controlled overnight rates and let the market completely control the longer term rates without buying all these JGBs, then interest rates might shoot up. And I disagree. I think, as I'll demonstrate, the demand for credit in the economy is really quite weak. A lot of it for the reasons that Shirai Sensei cited. And as a result, I don't expect any big spike in interest rates in Japan, but that reflects the sort of the weakness of the economy. Now, first of all, and this is my own take, what I did was, instead of looking on year-on-year rates, I sort of looked at what was the annual rate of inflation over the past 6 months. Because we saw a similar pattern where in the recent years, in recent months in the US, it fell quite rapidly. And here we see that the dotted line is all items, which are about 2% now, annualized rate. This is ex-fresh food, which was sort of BOJ's core rate, is below 2% already. And for the global core rate that people use, which is ex-food and industry, and energy rather, is already down to 1%. So we could have a situation where in the rest of 2024, I'm not predicting it, I'm just saying it's very uncertain, but we could have a situation which in fact inflation, the real core inflation is significantly below 2%. And there are some who argue the reason the BOJ rushed when the evidence was so uncertain is it feared that this might happen and they didn't want to lose the chance to move. I don't know if Shirai-san thinks that that's what happened, but that's a theory out there. But that's very uncertain. The real wage picture is also very uncertain. There is no basis for saying that we're going to have 3% nominal wages, which was what they need to get 2% inflation. The notion there is if nominal wages go up 3%, that increases the cost of companies by 3%, minus the rate of productivity growth, which is 1%. So 3% minus 1 is 2%, and therefore they're going to pass these costs on to customers. But in fact, what we see is in the larger symbol, there's no consistent trend here. Nominal wages are very, very sawtooth. And only one, it never hit 3%. It came close in one quarter. But generally, it's been very, very low. A few months, very few, even 2%, a lot below 1%. Real wages is the past 6 years, so long before COVID. In fact, if I went back to 2014, you see it even more, that real wages have been consistently falling, which is why we have the consumption figures that was mentioned. There's another sample which the BOJ prefers. The problem with the previous chart is that they don't sample the same firms, the same workers every month. So it's kind of a screwy table. And here's a sample where they actually do try to sample the same workers. And that seems to show a trend of it rising to 2%, but the sample is much smaller. And I don't know what it consists of in terms of size of companies, because the larger the company, the bigger the wage hikes. So whether this is reliable or not, I don't know, but I'm saying the results you get depends upon which database. And so the BOJ seems to have chosen a database that justified the policy they wanted to take, perhaps for other reasons. Then we look at consumption, and this is since 2013. So here is the Abe's first tax hike, consumption tax hike, and 2019 is the second. This is even before COVID consumption, and then comes COVID. But we see that consumption today, if we take 2013 as 100, today is 97. In other words, consumption is lower today than it was 11 years ago, which is unbelievable. And that has to do not with people refusing to spend because they're saving so much, but because their income has been falling. In fact, they're saving less and less and less because they have to eat into their savings, or at least save a lot less, in order to keep their consumption from falling even more. This is a sign of a weak economy. And when you have inflation, the BOJ theory is that inflation is a product of a cost push. That is, if the costs to companies and wages increase by X amount, the companies are going to pass these costs on to consumers. But that can only happen if consumer demand is strong, and we see consumer demand is very, very weak. So it's a very one-sided theory. And I would argue that the prospects for both wages and inflation are very, very uncertain. We do not know if the shunto wage increase, how much will be passed on to the small and medium companies. The shunto is just 16% of the labor force. So they want the other 84, it could be very, very low again. Again, why the rush to move? It does not make any sense. And to say they have confidence that in 2 years they're going to have a stable 2% inflation based upon a virtuous wage price cycle does not make sense to me. Now, the yen weakness, I won't go into that, but point is the yen is much, much weaker than would be the traditional relationship between interest rates. And so one has to wonder why the yen is so weak and whether that might push the BOJ to try to do something vis-a-vis interest rates. Now, the other side of it is, what's the demand for credit in the real economy? Well, what we see here is that this column, this gray area is all the deposits from companies and households going into the banks. And this is the loans that they make. And we see with every passing year, there's a bigger and bigger gap. They have all these deposits, but they're unable to make loans because the company's housing investment is down. Companies are not investing that much, which I'll show in a further slide. So then what do they do with all this money? They buy JGBs and they send it back to the Bank of Japan. So what we see, let me go back to this one a second. So they send it back to the Bank of Japan where they're earning, negative or zero on reserves. So as a result, if an interest rate is a product of what's the supply of savings compared to the demand to borrow those savings to invest, it's very, very unbalanced. Demand is very weak, and the result is that interest rates are very, very low. So here we have 15%, I'm sorry, of all loans to both companies and households, 15% charge less than 0.25% interest. I'm not sure that's even enough to pay for the computers that count it, the electricity that runs the computers, the salaries of the people who do it. At a number of regional banks, they're actually losing money in terms of their core operations of taking in deposits and making loans. Many of them are. 35% of these loans charge less than 0.5%. So the most zombified companies can look as if they're paying their interest bills on time, but anybody could do that if their interest rate is virtually nothing. So, and Ueda says that he doesn't think that deposit or lending rates will rise sharply from their decision. So I think we have a very, very weak economy, and that is not a recipe for a sharp rise in interest rates. If there were a sharp rise, you might see a lot of these zombies go under. Now, what about the corporate side? Well, the gray line is their cash flow, which is their profits and the depreciation of equipment. And we see it's going up and up and up. A lot of their profits come from the fact that they've been suppressing wages. While sales per worker have been flat, profits per workers are going way, way up because wages per worker are going down. So they got these profits coming in that they're not doing anything with. Here's the investment. Normally, they would take their cash flow and they would invest it, but here's their investment. This is all as a percentage of GDP. And we can see so there's this big gap between the cash companies are taking in and what is their need to borrow. And the result is, back here in the 80s, we had a more normal situation where firms need to borrow money because they invest more than their cash flow. The black line, by the way, is big firms. The gray line is all the rest of them. Now, their cash flow is so much greater than their investment that as a percentage of GDP, we got something around 6% for many years. In the last few years, it's been up to 7% of GDP is this excess savings of corporations. They're not borrowing. That's not a recipe for interest rates going up. It's also not a recipe for a healthy economy. And they're just hoarding cash for no good reason. So here's the situation to conclude, which is economists have known for years for an economy to be macroeconomically stable, wages have to, per hour, real wages per hour, have to grow at basically the same rate as output, productivity, GDP growth per hour. In Japan, GDP per hour has grown, but wages have been virtually stagnant for a few decades now. So how do companies sell their products if workers are not earning enough to buy what they make? And if corporations are not investing, somebody has got to be the buyer of last resort. And the buyer of last resort has been the government, running deficits year after year after year. The reason why Japan is addicted to deficits is because they're the only ones supplying this purchasing power in the economy. In the last 30 years, the real deficit has the deficit has averaged about 5.4% of GDP. That's a nominal number. So that is one of the impacts. And who's financing that? The Bank of Japan is financing by buying all of these JGBs, which is also the way they've kept interest rates down. They're going to continue buying JGBs. So I do not see this as a situation in which interest rates are going to rise substantially in the next year or two. And I don't see any justification for the BOJ saying it has confidence that the wage price virtuous cycle is going to be seen by March of 2026. So let me stop there.
Okay, thank you, Richard, for that added value. So now, Ms. Ann, if you'd like to make your presentation, please.
Certainly, thank you. I'm just going to pull up my slides here. It looks like it's visible. So I'm going to look at some of the same themes, but I'm going to give you a little bit of a different point of view on the Japanese economy. In fact, I'm probably a little bit more. I don't think that growth is suddenly going to go to 5%. No. But I do see some signals that the virtuous circle is alive and well. I don't think everything has been achieved overnight, no. But keeping in mind that the Bank of Japan cannot influence realized inflation. It can only really influence inflation expectations and therefore price setting in the future, that I believe the Bank of Japan has taken into account in its decision. And these signals do, if realized in the future, should lead to more sustainable inflation or reflation. And I will show you them in a second once the slides start working. Here we go. So yes, I think I will. I won't linger on this slide. It's another chart of PPI. It's another chart of inflation, PPI versus core Japanese inflation. We've seen some degree of pass through by corporates, and the household has finally been hit by some of that pass through. And as we've heard from Shirai-san, it's not necessarily very broadly based yet. That's true. However, if we take a look at the corporate sector, where real balances are not the last word, nominal growth has been a big contributor to corporate profit recovery. Of course, that means that corporates are able to move similar. They're able to move a similar volume of goods, perhaps not necessarily a larger volume of goods, and there's then this doesn't necessarily mean that they're improving margins yet. And meanwhile, as we've heard, there has been an increasing environment of labor supply shortage. So here we see the Japanese unemployment rate alongside the Tankan DI. So companies reporting difficulty finding staff. Meanwhile, why haven't wages really risen, even though companies have seen for so many quarters difficulty finding staff? Well, there's been an increasing labor force participation, primarily driven by, for example, women, as well as people beyond traditional retirement age. However, as we all know, labor force participation, improvements in labor force participation is finite. And right now, Japan is seeing similar participation to, or participation above and beyond some of its OECD colleagues. And on the right-hand side, we have this slightly messy looking beverage curve. I think it's the relationship between unemployment and inflation isn't necessarily clear. Core inflation, I should say, not necessarily clear, but it looks like we are on part of the curve that looks consistent with low enough unemployment that we should be expecting price rises and not declines. Again, we've seen this chart before, nominal versus real cash earnings. So this is why demand has not been so strong, even though we've seen increases in nominal labor cash earnings. The real earnings growth, income growth for households hasn't been there. And households and corporates have all built up cash. Households have 1.1 quadrillion yen on their balance sheets, and corporates have more than 300 trillion. That's all true. And looking at GDP, we've seen growth, but we've seen growth by something that's a very small part of Japan's overall national accounts, net exports. We've seen it, net exports pull far above their weight, and we've seen only this anemic growth in domestic demand, both private consumption and non-residential investment. That's true too. Perhaps you might ask me why I'm positive. Before we move on to that, we can take a look at some of the cyclical reflation components. We've had a very favorable yen environment. The weak yen has been good for large listed corporations, exporters, not so much for importers. And the low volatility has helped the Nikkei rally to new highs. Of course, the household says, well, what's the Nikkei got to do with me? Indeed, what has the Nikkei got to do with households? Well, we'll cover that. But first, let's take a closer look at the firms. So the firms, with the rally, have seen some improvement in their valuations. I know that the Tokyo Stock Exchange has set this comply and explain rule for firms with price book ratios below 1. Now the average price book ratio is above 1, even though half of the constituents are not participating in this above 1 price to book ratio. There have been some improvements in profit margins, although not as quick improvement as in revenues, and some improvements in return on equity, which however remain low by global standards. Now this, I think, here, this next slide is the crux of why I think the virtuous circle might stick, however. And it has a lot to do with firms, but it has something to do with households as well. So these are both graphics from the Bank of Japan that I've taken the liberty of translating. It's from a review article that came out in December. So here we see firms, first of all, the left-hand side, left-hand panel of the left-hand chart. We see firms in all industries, that's the solid line, as well as several industries that are particularly labor dependent. And we see, it's an inverted axis here, we see these firms increasingly reporting labor shortages. So they're going, the more negative we get on that axis, going up because it's inverted, then the more firms are experiencing labor shortages. But then with a 5 to 8 quarter lag, this is the definition that the Bank of Japan provides for chronic labor shortage. What actually happens? Well, we actually see investment. Because they're experiencing these labor shortages and they must replace labor with capital, we actually see investment, not only in fixed assets, but in intangibles, in software. Why is this important? Well, these are the fundamentals of digitization. These are the ways in which corporates can actually both hire more, both pay more, as well as become more productive by automating away the low-level tasks and hiring skilled individuals, of which, as we know, in Japan, there are plenty. Right-hand side, let's take a look at what happens at how clear the link is between the labor supply shortages and capital investment plans. So the blue bars here show between 2020 and 2023 firms that actually, what happens with firms' investment that reported labor supply shortages at the beginning of the year. So without a doubt, both in fixed asset investment as well as software investment, those who have experienced chronic labor supply shortages are investing more overall, and especially investing more, particularly in software, the key to productivity increases. So although we haven't seen productivity increases spread throughout the entire economy, we have seen some of these things, the necessary investments occur, and we've seen some of these necessary investments occur in labor-intensive sectors, within the service sector. So food and lodging, retail, construction, these are all sectors where some of these incipient signals are taking place. That's what makes me a bit more positive. Next chart, as we see, this is capital expenditure, both overall and ex software. So then the orange line here is the implied expenditure on software. One swallow does not make a summer. However, the Q4 technical recession that initially showed up in Japanese data was revised away thanks mostly to CapEx. And within this, we see that software spending has reached multi-year, double-decade highs. Of course, one data point doesn't mean it's going to continue. However, these are some very positive incipient signals. So let's take a look at the impact on firms. Granted, the situation of labor supply shortage and higher inflation isn't good for everyone. It's not all sunshine and bunnies. However, let's take a look at what might be happening when we look at bankruptcies in both the manufacturing and the services sector. Bankruptcies are relatively low because we're in a very accommodative environment. However, when we look at the ratio of services sector bankruptcies to manufacturing sector bankruptcies, they're at multi-year highs. And overall low, but still the ratio multi-year highs. Now, is this the canary in the coal mine? Does it mean that everybody's going to go bankrupt? No, it means that there is a possibility for something to happen that hasn't happened in years. I can't count how many times foreign investors have bent my ears saying, why does corporate Japan not care about their shareholders? How many zombie companies have you got to keep alive? Well, we have the mechanism right here for allowing attrition and a normalizing birth and death rate of businesses. We have tight labor conditions, which means that the government doesn't have to worry about hemorrhaging jobs when there is attrition. And then we have companies. This is Teikoku Data Bank data, and a series that I'm not showing you here since I don't pay for that particular series, is that a lot of firms are actually going bankrupt, or the number of firms going bankrupt because of labor supply shortages spiked during the pandemic and hasn't really fully come down. So there is the conditions are in place for a normalizing birth and death rate of businesses. And if the Bank of Japan does raise rates further, will this tendency speed up? I anticipate it will, but it's not entirely bad. Just moving forward a little bit, the household. And here we come back to the 1.1 quadrillion yen question about the household's balance sheet. The household's balance sheet is more than half in cash. Does that seem crazy? Perhaps, but it's fully rational in deflationary conditions. What are you going to do if you think that you can just consume more the next year just by hanging on to your cash? You don't need to even put it in a bank. So this hanging on to cash is perfectly rational if you anticipate price declines next year. So for even though the inflation that we're seeing isn't broadly based, it's pretty narrowly based, can households firmly say that they are going to be able to consume more next year just by holding on to cash? No, they can't. So they have to change their behavior. I know old habits die hard, and inflationary habits die particularly hard. There's a lot of persistence. You know, we build auto-regressive models to model inflation expectations. However, the fact remains that if even narrowly based inflation persists, households are not going to be able to persist in this type of behavior and continue to increase real growth. So what do they do instead? Well, I don't see it as a negative signal that households have started to question that what does the Nikkei reaching new highs have to do with me? It should have more to do with them. And there have been measures put in place such that we might have more to do. The new NISA provides tax incentives to increase financial participation, specifically investment trusts, and to do so in a relatively healthy way. I know that to date, a lot of households who do participate, the minority of households who do participate, tend to flip between theme funds and try to time markets. And even institutional investors are not that good at consistently timing markets. Well, putting the tax incentives on the tsumitate side means that it encourages dollar cost averaging, or yen cost averaging in this case. And so therefore, a perhaps more stable entry into markets targeting a longer term horizon of investment. So for those who don't think that the GPIF, that the national pension is going to be enough to fund retirement, there's a solution. And there's 1.1 quadrillion yen that we can put to use trying to make it happen. And lest you think that the tax incentives are meaningless, I wanted to show a chart that comes from that looks at comparative incentives in the United States. So this is ERISA in 1973 that really didn't take too much effect until the advent of the 401k, 1981 and onward. These are the incentives that led households to increase their participation in financial markets such that their participation in stock and mutual funds increased beyond 30%, stayed there, and additional measures such as the Pension Protection Act of 2006 and more recently Secure and Secure 2.0 have kept this household participation on an increasing trend. Do I think Japan is going to turn into the US overnight? No, I do not. However, 11% is very low. Incrementally, it can make a big difference. Households have a lot of cash. Consumption is a large part of Japanese GDP. So even a small incremental change can help offset some of the burden that is placed on exports in Japanese GDP growth and broaden the base of growth and therefore contribute to the virtuous circle. So actually, I've pretty much finished my my argument here.
Sorry that I have to keep. Okay, well, let's take questions from the floor. Yes, I think you have a question. Can you go to the microphone, identify yourself, and ask your question, please?
Hi, my name is Peter Morris. I'm a tech lawyer and an Asia Times journalist. So I want to ask you about software. So first question is, what percentage of the revenue of that software is going to Japanese companies versus American companies, number one? And then the second question is, Richard has said in previous lectures that Japanese companies, even when they do invest in new technologies such as software, they don't get the productivity boost that other countries do. If that's true, why do you think that is, and how to tackle that problem?
Certainly, I'll answer both of those
Sorry, I
questions.
think it was this addressed to Naomi Fink?
Well, I guess you, because you talk about
Oh, okay.
Okay, certainly, yes. So number one, where is Japan getting its software from? Indubitably, there's a digital deficit right now. Part of the reason why the yen is weak is because some of those flows are going to overseas firms to purchase software. Is that the end of the story in terms of which Japanese firms can profit from the digitization? Well, no, it's not. I think we've all been to convenience stores, we've all been to hotels, we've all been to Uniqlo within the last 12 months. And I think we've all observed that there have certainly been benefits, labor-saving benefits to introducing technology that's not entirely sourced from overseas. I think when I was living abroad, I came to Japan from time to time. There was a gap at the time of the pandemic, and there was a sea change between when I came here before the pandemic in 2019 and the summer of 2023. I walk into the supermarkets or the convenience stores or Uniqlo, and there's a lot more automation. I can't help but see this as a productivity increase, a labor-saving productivity increase. It has the spread all throughout the entire economy. Well, no, it hasn't, but that's where the opportunity lies as well. It's not one and done. It's not completely finished, but it's underway.
Okay. Richard, a reference is made to your lecture. Do you want to say something briefly on this?
Yes. You know what? The biggest important ingredient in the diffusion of digital technology is human capital. And according to Medi, Japan suffers about 400,000 to 500,000 fewer software engineers that it needs. It could go to about 800,000, extrapolating from past growth rates of software use. If that rate increases, there'll be an even greater shortage. Japan's not been able to attract software talent. So while I think it would be nice, and I think also software should be used for more than simply cutting costs, unless you tackle that human capital problem, it's not going to produce the results that Naomi foresees, and which I would certainly like to see, but I don't share her confidence we're going to see it.
Okay. I'd like to slip in a quick question about the yen here. That there's obviously a consensus that the Bank of Japan is not going to be in a hurry to raise interest rates, which would appear to be bearish for the yen, which is already headed into a bottomless pit, or so it seems. But on the other hand, interest rates elsewhere are going to be falling, presumably. So are these things, from the point of view of the yen, are these two things going to cancel each other out, i.e. rates will not rise in Japan, but they will be falling elsewhere, so therefore downward pressure on the yen will be limited. Who'd like to just have a go at that? Sayuri-san, would you like to have a quick...
About yen?
The yen, yes.
Yeah, so, the market, the way market look at exchange rate movement, the change. So right now, the market pay a lot of attention to the interest differential, especially long-term interest rate. But when I look at like 10-year yield, but also they also look at the monetary policy stance. So not only just looking at interest differential, but where they are heading to. So this March 19th BOJ's policy, I think the way the governor described to the public is they gave impression that they are not going to do a drastic interest hike. So that stance contributed to the yen's depreciation. So if you look at over this 10 days, and look at the long-term yield differences and exchange rate, and interest differential itself can explain. So this comes from this sort of market perception about the BOJ's monetary policy stance. So that one, as I said, it's not very easy for BOJ to do, but I think governor tried to say, he suggested that for time being, this JGB purchases will 6 trillion yen monthly will continue for time being. And then also he says, in his mind, he's thinking about QT. So I think in a way he suggested some more normalization may happen during his term. So, let's see. I think next topics will be when BOJ will start to reduce these monthly purchases.
Okay.
Yeah.
Anyone else want to comment very quickly on whether the yen has reached a bottom? Yes, Richard.
Yeah, in the short term, the interest rate gap is the most important determinant of the yen rate. But we may be seeing a shift because the yen should not be this weak if that interest rate gap still has the same pattern as had for the last few years. But in the longer term, the most fundamental reason for the weak yen is the weakening competitiveness of Japanese firms, including in sectors where Japan was a superstar, like electronics, and then other superstar sectors like autos. They now produce the products they sell overseas. They produce them overseas. So Japan needs a weaker and weaker yen to be able to sell. That's a competitiveness problem, and monetary policy does not influence that.
Okay.
I have a perspective on that. So on dollar yen, clearly, if we look at measure of fair value, purchasing power parity, then it's way off fundamentals. A basket of $1 in the United States buys more or less the same as something slightly under 100 yen in Japan. That's way off from 150. However, if we look at what's driving current markets, it doesn't appear to necessarily be fundamentals. We look at any other risk asset market, equities, especially U.S. equities, U.S. credit spreads. There's very low risk aversion and high demand for anything that's attached to a yield. I think there's a clear divide between current supply and demand fundamentals in the market today, and it's not necessarily fundamentally based.
Okay, interesting. Did you want to say something very quickly?
Yeah. So how this yen's depreciation is contributing to the higher stock prices? If we look at the Ministry of Finance corporate data, mainly from standalone, so not including foreign profit. Then if we look at this, I pay attention to sales to profit, sales to operating profit ratio. And then only large company have a very high this sales to profit ratio, but over these 2-3 years, no change. So this profitability ratio itself cannot explain why all of a sudden we have this sharp increase in stock prices. And then if we look at the medium-sized, small, medium enterprise, stagnant. So only basically explained by large company. So then why some large Japanese companies have high profit? This is what's happening. So when yen depreciate, it doesn't really lead to the increase in export volume, stagnant. Okay, but what they do is they don't adjust, export destination regions prices much. So they try to adjust yen-based export prices. So if you look at the yen-based export prices, huge increase. But if you look at the contract price-based export prices, not much. So that leads to the higher profit as a result of yen's depreciation. Plus, foreign profit converting into Japanese yen, boosting Japanese profit. So that is, I think, a correlation, why we see a strong correlation between yen depreciation and stock prices.
Okay, thank you. Any other questions from the floor? If not, I would like to quickly turn the discussion back slightly to a more macro basis. Paul Sheard, perhaps you can comment on this. But with interest rates set to fall in general, I wonder what impact you think that's going to have on the health of financial institutions. They're very heavily lent in the case of banks and others, and so debt levels are very high, banks are very extended. Is the health of the financial system going to improve on the back of falling interest rates or not? Could you give a quick view on that?
And Anthony, you're talking about the US, Japan?
I'm talking about US, Europe, everywhere really, in general. I mean,
Right. Well, I think interest rates falling from this kind of level, which, again, as I indicated in my comments earlier, look to be above more neutral levels. And so, one of two things kind of has to happen. Either we've got it wrong, or everybody's got it wrong, and central bankers have got it wrong about the level of neutral rates, which is really driven largely by a view of what the underlying natural rate of interest, the real equilibrium rate of interest in the economy is. Either they've sort of got that wrong, or interest rates, short-term policy rates at the moment are sort of far too high. So in terms of the health of the financial system and the banking system, if it is the case that neutral rates are around, let's say in the US 2.5, I would put them a little bit higher, maybe pushing up towards 3%. Then it's probably good for the economy and good for the financial system if the economy sort of does complete its normalization. So in other words, the level of interest rates at the moment are reflecting a disequilibrium or an unusual situation, which is that inflation has shot up and that needs to come down. So the economy needs to come back into balance. So I wouldn't see the fall of interest rates kind of per se as something that would be of concern to the financial system as a systemic kind of issue. Obviously, in the US, when we did have the inflation shock and the interest rate shock, that was when, as Warren Buffett put it, the tide went out, and we saw who was swimming naked. And we had, a few stresses coming into the US financial system and the banking system in particular. But I think, by and large, I don't see huge imbalances in the US financial system at the moment. And part of that is just the lightning doesn't strike twice in the same place, and a lot of things changed after the global financial crisis, and particularly around regulation and capital adequacy requirements and whatnot.
Perhaps I'm over-influenced by Mervyn King's book, in which he suggests that lightning does strike twice in the same place, and we may be headed for another problem. But anyone else comment on that? Richard, maybe? Or...
Certainly. I think we do see very different composition of balance sheets, especially in the United States, but probably a bit more worldwide. I mean, we can compare and contrast balance sheets from households in the United States and in Japan with what's going on in China at the moment, with the property sector woes and a massive overhang of debt. So we've got very different balance sheet pictures, very different credit conditions in these various geographies. The one thing that we do see that perhaps is a bit uniting is that we have globally pretty easy financial conditions. And the thing is, financial markets also feed into financial conditions. So this is one thing that probably every central bank is taking a look at. If you have financial conditions that are fed by asset prices, then it's feasible that central bank policymaking may be less effective than if this were not the case. So it is a bit of a warning signal for Japan as well as other geographies if we do see a decline in demand due to reversal of those financial conditions. And that wouldn't be the central bank's, at least immediately the central bank's fault. I guess you could say that there was a lot of liquidity left in the system. It could be a lot less predictable and a lot sharper than your average central bank cycle.
Cyrus, I think you want to say something.
Yeah, so I want to mention about the impact of central bank monetary policy decision on interest rate. Now, there are discussion among U.S. Central bankers. There is an asymmetry with regards to when the central bank lower interest rate and they do the QE, and when they start to raise interest rate and conduct QT. There is an asymmetry. The impact coming from, especially from QT, is rather limited compared to the impact of QE when they introduce asset purchases. The impact on downward pressure on the long-term yield is really big. But when they start to do QT, there is no symmetric upward impact. So there are a couple of discussions, and that may be so that because the impact on the upward pressure on the long-term yield as a result of QT is rather limited, and then I think that's partly a reason why financial sector is rather no serious concern at this moment. So why is that? So a couple of reasons is when the central bank introduced QE, and that happened when the market under stress. So when the market is dysfunctioning, a lot of anxiety, and when the central bank does something, there has a lot of impact. But now, when central bank does the normalization, in the market is more stable, economy is better, so less impact. The second point, when the central bank does either short-term interest rate hike or balance sheet shrinkage, it's kind of expected. People kind of know to what extent the Federal Reserve can reduce balance sheet. We already know, right? Central bank, Federal Reserve is having a balance sheet around $7 trillion US dollars, but probably it's not going to be below 6 trillion. Everybody knows that. So it's more anticipated. But when the central bank does QE, it's a little, there is uncertainty, how long they are going to do it, how much. So already anticipated, so that already reflected in interest rate. And other things, so when interest rate go up, some coupon rate are higher, so somebody want to buy. So in the case of U.S., individual people, I hear the one who purchased the U.S. government bond. So I just wanted to.
Okay, thank you. Any questions from the floor on any aspect of Calden, please?
Thank you for your presentation today. My name is Khaldoun Azhari. I'm with Panoramic News. My question is about the Japan's ranking in the world economy. Recently, it's dropped from number 3 to number 4. And I heard some explanation that is because of the yen exchange rate. The yen is weakening. So do you think if the yen became strong again, Japan will come back to the number 3, for example? And do you think, what's the meaning of Japan's number 3 in the world or number 4? How can this be translated to the quality of life in Japan and the strengths of Japanese economy globally? For example, we hear that India might become even stronger than Japan, but they say India and China, the difference between so-called poor and rich is huge. In Japan, it's basically same. So how can you anticipate the Japan position in the world and its power globally? Thank you.
Is that addressed to everyone? Everyone. Okay.
May I share a slide?
Go ahead.
Yeah, I have something here that hopefully speaks to the question a little bit. Here we go. And no, it's not this one. Try and put that down one. Here we go. So if we look at GDP growth overall, we can't deny that population growth has some input into GDP growth. So given that Japan has a shrinking population, I don't think we can have massive hopes for overall GDP growth unless there's, let's say, a drastic change in immigration policy. However, when we look at per capita growth and the accounting of per capita growth, there's a very different story. And per capita growth does matter for households. So here is a chart that I've shown up here of Japan's growth accounting. So the Y over N is per capita, it's per capita production. My approximation of the two lines there, labor share of income and capital share of income. As you might notice, it's very gradual given the scale, but we saw a multi-decade decline in labor share of income. That's picking up again. It's not only in Japan, that's happening in many other places in the world where wages have started to rise. Capital share of income is offsetting and declining. In fact, that's in line with macroeconomic it's in line with theory. You should basically see a stable labor share and capital share of income over time. What we're also seeing that's hopeful is the total factor productivity. That's labor augmenting technology. It's actually started to pick up again. So we have what looks like development toward a balanced growth path, stable shares of labor and capital, and increase in total factor productivity, which in turn is driving per capita GDP. I think this is probably what's important for Japan to take a look at, even though we're not necessarily, given the demographics, we're not necessarily going to see Japan on an overall GDP basis probably compete with the likes of much more quickly growing economies such as India.
Anyone else like to? Yes, Sayuri-san, please.
I'm not sure about this chart, but if we look at the government and Bank of Japan's this accounting, so right now Japan's potential GDP is 0.7%, and of which the labor side is a negative, because limiting workforce and declining number of working hours, and a very tiny contribution from capital accumulation, and just a 0.1. So remaining come from TFP. So it's true that TFP dominates Japan's potential growth, but still it's not big enough, because its total potential growth is 0.7. So, and then I think even government expects there will be a decline in potential growth. So I guess it's nice that Japan see a positive contribution from TFP, but they have to do much more.
Okay. Anyone else? I mean, these changes in productivity, are they going to change the order of the world leaders in terms of GDP size? Paul, maybe anything on that or not?
Well, yeah, I mean, we get a little bit in the weeds here, because I think the question was about Japan's ranking in the world, and of course there are two measures. One is the sort of just straight nominal GDP comparison, which kind of the man or woman in the street tends to look at, much of the journalistic community. Then there's the purchasing power parity way of doing it, which is kind of what the economists, IMF, World Bank, card-carrying economists say you need to look at it in terms of purchasing power parity. It just turns out that Japan has, and those rankings are different. Typically, emerging markets move up on PPP comparisons, and less so for advanced economies. It just so happens that I think at the moment Japan is number 4 on both measures. On the reputable measure, if you like, purchasing power parity, it's China, US by a big margin, then it's India and Japan. And this is just overall size of the economies. This is your weight in the world, if you like. On a nominal basis, it's the US, China, and now Germany apparently is just snuck ahead of Japan. But as I think Naomi and maybe Sayuri-san were pointing out, what is important for living standards is, of course, per capita. So then you look at per capita GDP on a PPP basis and per capita on a nominal basis. And there you see that Japan has, because of the weaker yen, and because of the deflation on a nominal basis, has really slipped down. I think it's more like around about $33,000 per capita now. Purchasing power parity is more about 56,000, just off the top of my head. US is like 80%. And one number that is a little bit concerning maybe to Japanese might be that South Korea is moving ahead of Japan, even on a PPP basis. So I think that turns the whole discussion into, how do you raise real living standards in Japan? And you obviously start talking about all the things we normally talk about: innovation, entrepreneurship, structural reform, etc. Immigration can help as well, if it helps to make the economy more efficient, which I think it can help to do. But it's I'll leave it there. You get into the weeds with these comparisons.
Okay. any questions from the floor? Yes, please.
Thank you, Nishimura with Freelance. My question may go to Shirai-san, and you referred to the weakness of the consumption in Japan. So, what kind of policy taken by Kishida administration, not the BOJ, Kishida administration, work for tackling this problem? Which is, do you think the tax reduction in June or policy on the low birth rate will work? Thank you very much.
So Prime Minister Kishida is trying to, give some allowances for the children and education, and that's quite important. But I think tax cut may not help much to boost the consumption, because everybody knows in Japan we have huge debt, and having a tax cut now, maybe we have a tax increase in the future. So, and then longevity, longevity, when people do not know how long to live, and they like to save. So it's very difficult to boost consumption in this kind of economy. So structurally, we have this issue. So how to increase real consumption? That's a very difficult, very challenging.
Okay. We're up against time, but very quick final question, I promise, from me. Central banks don't seem to be in a hurry at the moment to, certainly not a bit panicked into lowering rates further quickly. So given uncertainties in the global economy, do you think that the rate of reduction in central bank interest rates is going to accelerate from here, or is it going to remain more or less as it is at the moment? Any views on that?
Well, central banks aren't really able to jump into cutting rates even perhaps as much as they would like because of inflation, because inflation remains much harder to conquer, I think, than they expected. So if we do see a decline in inflation, then perhaps they can speed up the pace of cuts or even step in earlier. I personally don't really see many signals that there will be a massive decline. There might be some gradual disinflation, but if you look at the US, for example, the basis effects for inflation are favorable in the first half of the year, not so much in the second half of the year. So, are we actually going to get to that 2% level before the second half of the year? I think fewer and fewer people are expecting that. So central banks might have a hard job ahead of them.
Interesting, thank you. Anyone else want to make a comment on that? If not, we are...
Well, Anthony, yes,
Paul,
yes,
please.
I just really go full circle back to my starting comments that it really will depend on, what happens in the economy. So, will we get a shock? I mean, the geopolitical shock, if China had a hard landing and that started to reverberate, or if the accumulated monetary tightening, and again, the remarkable thing in this last year or so has been that inflation has come down more gradually than most people expected. First of all, it went up more than people expected. It's come down. So central banks have really had to put their foot on the brake. Again, particularly the Fed, ECB going from minus to now 4%, Bank of England, and a lot of people were fearful that would lead to some kind of hard landing. It didn't, although there is more weakness in Europe and the UK than certainly in the US. But if it turns out that a lot of that monetary tightening starts to hit the economy with a lag, that's when you'll get the central banks having to cut interest rates a little bit faster. But given how things seem to be going at the moment, and given the behavior of inflation, again, I would say the US will be probably slower to cut rates than we'll probably see in Europe, where there's just much more weakness in the economy. And I think Europe is being affected more by the disruptions from the Ukraine war as well.
Yeah. Thank you. Sayuri-san, quickly.
Yeah, very quickly. I just worry about the stock price bubble. So interest rate will start to come down, I'm pretty sure, around June, right? And I think US inflation is already PCE 2.4, Euro 2.6, so they probably will start to lower interest rate around June. And then already stock prices are too high in many, US especially, and to some extent Japan too. And then I think this might lead to the even higher prices, stock prices globally.
Interesting. I should have raised that question earlier, obviously. Richard, closing comment or not?
But I'd like to go back to the question of earlier about Kishida's program on demography, if you don't mind, which is, one of the, Japan spends one of the lowest, government funds education, high school education, college education, public funds for it are very, very low by international standards. And it's one of the reasons why people are having fewer children. And one of the reasons why their consumption is low, because they're spending money on educating their kids. And I don't think the Kishida program, I think it feels like to me a gimmick and not really addressing the root of the problem. Having said that, I think countries have found it everywhere very, very difficult to raise fertility rates. And those who've tried much more seriously than Kishida has also had a problem. One final quick comment on that. Among people with regular jobs, men in their 30s, 75% of them are married and with children. Among non-regular workers, men in their 30s, only 25% are married. They can't afford. So when you have this growth of the non-regular workers, is a huge contributor to the demographic problem of Japan.
Okay. All right. Well, I'd love to go on, but I'm afraid people have schedules to keep to, so I'd better stop. I'd like to thank sincerely all four panelists. Thank you very much for coming, contributing your collective wisdom. As is our custom, we give a one-year honorary membership to our guest speakers, Naomi-san, Sayuri-san. Paul and Richard, I think your existing one-year memberships will be extended duly by email or whatever means. So thank you very much. So again, please join me in thanking our panelists.
Thank you.
Thank you.
Thank you. That winds up the discussion. Thank you.
Thank you.
Thank you.